Warren Buffett's portfolio at Berkshire Hathaway now has more than $320 billion in cash, and the media writes articles on this topic that insinuate that Buffett sees problems on the horizon and that somehow those problems relate to us, and it instills this sense of fear or loss aversion. So we end up clicking on the article, but it's really just a waste of time. So in this video, I'm going to share three things that are worth your time. The first is I'm going to expose the lies of omission that the media is making on this topic. The second is I'm going to talk about how Berkshire Hathaway's portfolio relates to how you should be managing your retirement portfolio, and I think the answer may surprise you there. And the third is I'm going to share Warren Buffett's own advice on how to invest in stocks, and this is something that you can use, especially if you're nearing or in retirement. And just before I get started, you're right now watching someone who knows virtually everything there is to know about Warren Buffett's career and his company, Berkshire Hathaway. I've spent hundreds of hours reading every letter that Warren Buffett's ever written, going back to 1957 and all of his other writing. I also got Warren Buffett's permission to include some of his writing in my book on retirement income called Income on Demand. And I've actually named my financial planning firm Farnam Financial based on Warren Buffett running Berkshire Hathaway on Farnam Street over in Omaha, Nebraska. So you are listening to an expert here. So with all that said, let's dive in. Now, there's two parts to the media's lie of omission. The first truth is that Warren Buffett makes buy and sell decisions based on price, not short-term market prediction. And the second truth is that despite Berkshire Hathaway's large cash position, they still have the large majority of their funds invested. So let me explain a little bit more about both. The first is that Warren Buffett has a guiding principle when it comes to picking stocks. And what he says is that the iron law of capital allocation is what's smart at one price is dumb at another. So here's what that means. If a given business or a stock, they're the same thing, if it's worth $100 based on its fundamentals, buying it at $50 is a very smart move. And buying that same company for $150 is a dumb move. That's the bottom line. So if you're seeing a headline about Buffett selling a particular stock or perhaps holding a larger than normal cash position, it's more than likely due to his view about the price of a specific company.
Unfortunately, I sold a little too soon, but it was 100% a decision based on valuation. If it went down a lot, we'd buy it back.
Do you remember how low prices got during the fall of 2008 during the Great Recession? So Warren Buffett wrote this article for the New York Times. It was an op-ed piece, and he talked about buying American stocks. And he really was doing that, and he made tens of billions of dollars in doing so. And the point is that if a high-quality business became available for sale at an attractive price, Buffett wouldn't hesitate to write a check for $300 billion. He doesn't make investment decisions based on market forecasts or what the Federal Reserve is doing with interest rates, or even the direction of the economy. Those factors don't even enter the conversation. In fact, here's one of my favorite quotes about that, where he says, "Charlie and I firmly believe that near-term economic and market forecasts are worse than useless." And the reason why Berkshire Hathaway's cash position is so high right now is they've been selling Apple stock, which they first purchased back in 2016, and the price has skyrocketed over 5 times what it was since back then, and they've sold over $140 billion worth of that stock. And you can bet that if it went down a lot, they'd buy it back. So to summarize here, Buffett is making buy and sell decisions based on the price of specific companies, not market forecasts or the direction of the economy. Okay, so now let's talk about the second part of the media's lie of omission. The truth here is that Berkshire still has the majority of its money invested. So yes, it has over $300 billion in cash. However, it also has $300 billion worth of stock currently invested. And in addition to that, it has another $500 billion worth of wholly owned businesses that it owns. So these are businesses ranging from Dairy Queen to Geico Insurance to even the Burlington Northern Railroad. In fact, Berkshire has the most money invested in America of any company in history, which is a pretty startling fact for a company that was a struggling textile mill back in the mid 1960s. Okay, so to summarize again here, Buffett's making buy and sell decisions based on price, and despite the cash holding, they still hold $800 billion worth of stocks and businesses. And the truth is, the media is just largely excluding this from the reporting. But now that you know the facts, you will probably spot the omission next time you're reading an article on that subject. So the question becomes, how does the portfolio at Berkshire Hathaway, managed by Buffett, relate to how you're managing your retirement portfolio? And I have an easy answer for you on this. They have no bearing, no relationship whatsoever to each other. And it's really not worth focusing or paying attention to what's going on in Warren Buffett's portfolio. There's two primary reasons why. It's both goals and time horizon. So at Berkshire Hathaway, the time horizon is perpetual. They're making investments that they expect to pay off in 25, 50, 100 years from now. At best, our retirement horizon is 30, 40, 50 years tops. The second is just goals. So the goal, actually the purpose of Berkshire Hathaway as an entity is to maximize shareholder wealth over time, and to do that by owning businesses. The goal of retirement is funding our lifestyle, and then maybe as a second priority, passing on money to heirs and other beneficiaries. So is Buffett a stock picking wizard? Yes, absolutely. But what he's doing at modern day Berkshire Hathaway just has no relationship whatsoever to your retirement portfolios. You can save yourself a lot of time thinking about that. The last thing I want you to get out of this video is Warren Buffett's own advice on how to own stocks. And he gives some really specific advice here that's applicable for 99% of investors. And that is, for whatever portion of stocks makes sense for your retirement, whether that's 10% or 90%, that portion be invested in index funds. And I actually made a video on this, which you can click right here at this tan link. But an index fund is just a basket of stocks that represents the entire stock market. So you get a lot of diversification. The fees are extraordinarily low, like 1/20th of 1% per year. And you also have a higher reliability of returns versus individual stock picking. So if you own an index fund, functionally, you're an owner for every company in America, and all the CEOs are working for you. And it's a lot easier to get ahead making money that way versus picking individual stocks and potentially being right or wrong, not only about the future of the company, but the price that you selected going in and getting out of it. So to summarize Buffett's advice, for whatever portion of stocks makes sense for your portfolio, use index funds. Okay, friends, remember to dream big and know that you can have the retirement you want if you plan for it. And lastly, I'm Jonathan Bird, founder of Farnam Financial. We help clients who are either near retirement or in it, and we help clients kind of turn their financial house into their financial castle, insofar as a castle represents things like security and protection and longevity, peace of mind. So if you're curious about how we can help you, you're welcome to visit us at farnamfinancial.com. Thanks.